This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now, at the end of that last session, I left you a little planning exercise to sort out and to resolve, and that was to determine, given the choice, 31st of March, 30th of April, which accounting date would we choose or recommend for that client with reasons as to why. Now, what you'll see on the screen in front of you there, I've summarised what those assessments would be for the relevant tax years, where we chose firstly 31st of March or secondly 30th of April. Now, your first thoughts in making the call between do we choose March or do we choose April as our accounting date may have been the point that we referenced earlier, and that was about the level of overlap profits that would arise. What did you know? You knew that if you chose the 31st of March there as your accounting date, there would be no overlaps. Whereas if you chose 30th of April, that would maximise the overlaps at some 11 months worth of overlap period. What that would mean is that the bigger the overlap, the amount of profit that arises, then the credit back in 10 years, 5 years, 20 years from now, whenever you cease trading, the value of that overlap is going to erode over time. Again, just through the normal effects of inflation there. So that you may have thought to be a compelling argument, and it is an argument, but I'd suggest not compelling. It's an argument for saying, oh, well, use 31st of March. So some of you may have gone down that route. Others of you, I hope now, have seen that there's more to this than just looking at the amount of overlap. And that is year by year through the opening years of that new business. What you want is to be assessed on as low a profit figure as you possibly can. And whichever route, therefore, gives you the lower assessments, because they are going to be different at some point here, that is the route that I will choose. Now, just have a little look at what we've got here in relation to that. What have you got? You've got that in the first tax year, we've got £9,000 being assessed, whether you chose March or April as the accounting date. Remember, I made sure that the profit figures that we used were on, again, the same average profit basis. £3,000 for the opening 15 or 16-month period, and effectively £5,000 for the 12-month period when we had a £60,000 profit for our first full year end. So no difference in 1617, no difference in 1780. Again, £36,000 was the assessment under each choice of accounting date. But look at what has happened in this critical third tax year. If we chose 31st of March, you were able to use current year basis, and you went on, therefore, to use the second accounting period of profit, where the profits were higher, and that was £60,000 being assessed. Whereas, if we had chosen 30th of April, then for this third tax year, you yet again used the profits of the opening 16-month period, which repeated the assessment figure for the second year at £36,000. So there's the critical question. In the 1819 tax year, what would you rather be assessed on? Would you rather be assessed on £36,000 or £60,000? Now, I'd hope you don't have to be Einstein to work out, yeah, I'd rather be on 36. If you went with March as your accounting date, you're going to have an assessment £24,000 bigger than it would have been had you chosen April. Now that, if, for example, and you may well be here, you probably will be, a higher rate taxpayer, if you got an extra £24,000 in the higher rate tax band of 40%, 40% on 24,000 is what, 9,600. That's very nearly an extra £10,000 of extra tax. Once we've counted in what you don't know about yet, we haven't seen, but we'll see as national insurance contributions that would be payable on these profit figures, then we're probably talking about a figure closer to, if not above, £10,000 extra tax for the 1819 tax year if you chose the 31st of March. That is a very compelling argument, therefore, for using the 30th of April and having a much lower tax figure to pay, both in terms of income tax and also in terms of national insurance contributions. Why has it worked out this way? Because what I've done is to give you profits that were going up on an average profit basis. Profits were increasing from the first to the second accounting period. And if that were to continue to apply, then what you discover is each subsequent year, again, April would mean you're being assessed on a lower amount of profit. Remember, if you'd chosen March, then for 1920 tax year, that would have been the year ended 31st of March 2020. And if that profit period, for example, had been £70,000, I could have made it higher, but you'd still see anything bigger than 60, profits are rising. That year on year thereafter, so long as the profits continue to arise, that the 30th of April date will assess you on a lower profit because it's an older period. That £60,000 there for 1920 tax year, that was the year ended 30th of April 19. If you choose April, you're tested on an older, you're assessed rather on an older period, year ended 30th of April 19, rather than the year ended March 20. If profits are rising, older profits are smaller profits, and therefore choose the 30th of April. What I could have done in this question was to give you a big opening period of profit. Profits were being made at a higher rate of profit per month than they were in the second period and potentially the third period. So if profits started big and then declined, the last thing that you would want, as you've seen here, is for the first 3 tax years to all be based on that bigger profit. You would want only the 2 tax years to be based on the bigger profit, meaning that by the time you got to the 3rd year, the actual profits now coming in would be lower, and therefore you'd have a lower figure. So a simple rule of thumb here to use: if profits are rising in opening years, choose the 30th of April. If profits are declining from the opening period to the future periods there, then you would use 31st of March. Okay. Hopefully, therefore, we've understood the reasoning behind our choice of accounting date. And for those of you who pick 31st of March, based on our comments about overlap, it's a valid point, but it's not the most compelling argument. The most compelling argument is looking at that 3rd year there and seeing that if you chose March, you could be paying about an extra £10,000 worth of tax for the year. And so long as profits continue to rise, again, you'd be paying each year, if you chose March, on a higher profit rather than a lower profit, and you'd pay more tax accordingly. Answer: choose the 30th of April there. So a little bit of planning, therefore, for that purpose. Okay, now we should be able to deal with any opening year's problem. Whatever date we started trading, whatever accounting date we then choose, whether we have a short period, whether we have a long opening period, whatever circumstance we see, we should always be able to establish what are the assessments for each tax year, and also there, what, if any, are the overlap profits that arise and what happens to them. This is work that could be tested across the board in terms of your exam in any of the 3 sections of the paper. Again, there's a need to know these rules. Opening years always cause trouble because there are so many different rules that need to be learned, specifically and most importantly for the 2nd year. The only way you'll do that is with practice. So at this point, again, you may wish to pause the presentation and for you then to work through from the chapter. If we go back here to the chapter, work through on that chapter examples 2 through to 4, which are further examples using opening years. You may already have done them, but if you haven't, work examples 2 through to 4. Then rejoin us again so that then we can deal with, as you will see here, closing year rules. Now again, don't panic at this point. Don't think, well, those opening year rules, they were horrendous. There's so much to learn. My brain is going to explode. No. When it comes to closing years, it's a whole lot easier. There's just 3 steps that we have to learn to be able to work out the assessments over the closing years. Learn them, apply them, job done. Maybe therefore, let's say that's what you get in your exam. But pause now, work those examples please through to from 2 through to 4. Check it out with the answer at the back. Make sure that you are happy with them, and then again pick it up again from this point onwards, where we'll deal with those closing year rules. Okay, let's have a look therefore at the closing year rules, hoping that now you have resolved the issues and practiced those issues in relation to opening years. Right, the rules for dealing with the closing years of a taxpayer ceasing to trade, as we said, and I repeat and reassure you, much more straightforward than when we dealt with the opening years with all the different options that we would see. CYB will be used up to and including the penultimate tax year. The word penultimate means the one before last there, so the penultimate tax year, the one before the final tax year, one before last. The basis of assessment for the final tax year is then as follows. You want any remaining trading profits from the end of the basis period for the previous, the penultimate year of assessment. So this is either going to be 1 or possibly 2 periods of profit that will exist. So any profits as yet unassessed up to and including the penultimate tax year, there's only one other year they can go into, so it or they go into the final tax year, taking you through to the date of cessation. Remember then, any overlap profit, sometimes known here as overlap relief, the terms can be used synonymously when dealing with a closing years example. Any overlap profits that arose in opening years may now be credited back. They will be deducted here in deriving the assessment for what now is the final tax year, and that deduction, you can label that as overlap relief. Okay, this, I said, could be done and dealt with in a 3-step approach. So let's therefore just take you through what those 3 steps are. Now, when dealing with an opening years problem, the first thing that we had to do was to identify the first tax year. So now what do? We firstly identify what is the final, what is the last tax year in which we traded. And identifying the final tax year will be based on what date? Well, when you started to trade, the start date told you the first tax year, so very obviously this final tax year is based on your cessation date. When did you finish trading? So that is your final tax year. Having identified it, we note it and go back. Second step, go back to penultimate tax year and assess that penultimate tax year, and indeed any earlier tax years that you may be required to deal with, but assess the penultimate tax year, any further tax years before that as well, using CYB. We use current year basis, we've seen in the note, up to and including the penultimate tax year. So we therefore will use CYB in that penultimate tax year. And that then means we come to the third and final step, which is all remaining profit assessed in the final tax year as reduced, if of course there is any, as reduced by any overlap profits, or as you may now refer to it here, overlap relief. That's the idea, that's what we do. Okay, let's therefore work a little example based on those rules and see how we deal with it. Okie dokie. So, we are told taxpayer had prepared accounts to the 30th of September in each year prior to ceasing to trade on, well, let's make that the 31st of January 2018, prior to ceasing to trade on the 31st of January 18. So we'd originally prepared accounts through to the 30th of September. And what they'll then, of course, do is to give you what were the tax-adjusted trading profits for the periods leading up to that cessation date the 31st of January 18. Okay, let me give that information to you. Oops. Accounting year end. Now, we previously prepared accounts to the end of September. So we may be told this accounting year ended 30th of September 16, accounting year ended 30th of September 17, and then the final period through to a cessation date of the 31st of January 18. So we prepared accounts to our 30th September date all the way through to the 30th of September 17. We then traded on from the 1st of October 17 through to the end of January 18, so another 4-month period there, before then ceasing to trade. What tax-adjusted trading profits did we have for these periods? I'll tell you that we had £50,000 as the tax-adjusted trading profit to September 16. That had fallen to £20,000 for the year ended September 17. We can see the writing is on the wall for this business, and the period to the 31st of January 18 there was then a further £7,000 worth of profit. What we're also told that we would need to be aware of is what overlap profits arose in the opening years. And the other thing that could be done here, you may be given a relatively short-lived business and you're actually told the start date and then all the way through with the accounting periods to the cessation date. So you have to use both your bases of assessment in opening years to work out the opening year assessments and to determine then that overlap profit, which you then use on the cessation of trading, as we know, crediting it back, reducing what would have been the assessment in the final tax year of trading there. And I'll tell you now that those overlap profits here amounted to some £5,000. Okay, now remember we had that 3-step approach. Back at your note, what does it say? Step 1, identify which is the final tax year, and that's based on your cessation date. There's your cessation date, 31st of January 18. So what tax year does that date fall within? Again, basic questions. So the 31st of January 18 falls, of course, within the 17-18 tax year. So you now know that the final tax year will be 2017-18. Once you've identified the final tax year, go back to the penultimate tax year. So if you know the final year is 17-18, then the penultimate tax year must be 2016-17. 2016-17. And assess using CYV. So what period will that be? That will be, now look again at the information in the question, what was our year-end date? 30th of September. Which 30th of September, therefore, falls within, as we know, the 16-17 tax year? Oops. Very obviously, that will be the year ended 30th of September 16. What profit did we make for the year ended September 16? That there, as you can see, was £50,000. So in it goes. £50,000 is the assessment. Step 1, what's the final tax year? 17/18. Step 2, go back to penultimate tax year. You now know that that must be 16/17 and assess using CYB. Step 3, the third and final step, list out any remaining profits. That is either going to be 1 or maximum, as here, 2 periods of profit. Take away from that any overlap profits, any overlap relief that is available to you. What will that therefore lead to here? We've got as far as September 16, so we've got therefore these two figures to include: year ended September 17, final period to January 18, and then take away those overlap profits. So, see, I can remember what those numbers are there. So we will have, going into 17/18, accounting year ended 30th of September 17. We'll also then have the period to 31st of January 18, and we will then deduct our overlap profits, or otherwise known as overlap relief. Now, our year ended September 17, do check me, but I think that was 20,000, followed by 7,000, and our overlap profits were 5. Just check I have got that. Yeah, 20,000, 7,000, and 5,000. Lovely stuff. Okay, what does that therefore give us as an assessment for this year? 20 plus 7, 27 less 5 is £22,000. £22,000, job done, assessment sorted for final tax year. And that's it. All we've got to do. Closing years, so much easier than those opening year problems, where again, so many different options depending on your start date, your choice of accounting date, as to what the assessments could be. None of that trouble here in closing years. 3-step approach. Look at your cessation date. What tax year is that? That's the final tax year. Note it, leave it, go back to penultimate tax year. Penultimate tax year, assess using CYB. Put your CYB assessment in, and then you can, and if you have to go back further, of course, do other prior CYB assessments. But after penultimate tax year, all remaining profits, it'll be either 1 or 2, go then into the final tax year. Take away, if there is one, any overlap profits in the form of overlap relief, and you've got your assessments duly sorted. Okay, now in relation to our notes here, if I take you back to that, we've got the rules for closing years as we've seen. We've then got example 5 for you to work out what will be the assessments for bodies there who has ceased to trade. Okay, work through that one. So again, you may want to pause at this particular point in time, work that exercise, make sure that you're happy with those rules for closing years, and then join us again for the last part of this particular session anyway, where we look at the basis periods for capital allowances. Okay, basis periods for capital allowances then now. Now remember, as we saw in the previous chapter, chapter 5, we prepare a capital allowances computation for the business's accounting period, for its period of account. We don't do capital allowance computations for tax years, we do them for the business's period of account, whatever period it's prepared its accounts to. We also, of course, did our adjustment of profit statement for that same accounting period. Adjusted up the statement of profit or loss, deducted capital allowances, got the tax adjusted trading profit, and then, as we have seen, for any tax year of assessment, from the very first through to the very final tax year of assessment, apply the relevant basis of assessment and work what figure is to be taxed on the income tax computation of that tax year. What particular problems does capital allowances give us here in relation to these periods? Well, nothing really that we haven't already made mention of within Chapter 5. It's just a question of applying this. Right, the first circumstance, that we see here, capital allowances, we've said, we're going to work them out for the trading profit period, the accounting period, then in opening years. Right, what happens in opening years? Capital allowances are deducted from the profits before the opening year rules are applied. Well, of course they are. We must work out, after capital allowances, what is the tax-adjusted trading profit of the accounting period. That's everything that we did in Chapter 4, Chapter 5. Took away capital allowances, got the tax-adjusted trading profit, and then, as we have seen, we worked out what figure of profit would be assessed for any tax year using the relevant basis of assessment. Of course, when we deal with the opening years, what we know is that the opening period that we prepare our accounts for is not necessarily a full 12-month period. And what that means is it could be short, it could be long. So for an accounting period longer or shorter than 12 months, what repercussions does that have within the capital allowances computation for the period that you're dealing with and for which the computation is to be prepared? What you should now remember is that there are three types of allowance available. There is AIA, there is WDA, there is FYA. FYA is unaffected by the length of the accounting period. Whether I start with a 4-month, a 14-month, a 12-month, whatever length of opening period I have, if I have a first year allowance available, I bought a low emission car here, then I get 100% allowance. And I get that irrespective of the length of that opening period. But where there is an AIA and WDA that is available, then I have a problem. Because what I must remember is that the AIA is £200,000 per annum based on a 12-month period. And my WDA is either 18% or 8% per annum, again, on a reducing balance basis. So I've got annual figures. So if therefore I started trading with a short period, say 9 months, then I'd have to take 9/12 of the 200,000 AIA. So the maximum available 9/12 of 200 would be £150,000. And equally, if I have that 9-month period, my writing down allowances must be 9 months worth of what would have been 18% or what would have been 8%. So you've got to time apportion both the AIA based on the length of the opening period and also time apportion the available WDA. If, of course, with an unincorporated trader, as we've seen with the examples we've done in this chapter, you might have a 15 or a 16-month bit. It might be long rather than short, in which case I'll have 15/12 or 16/12 of the available AIA or the available WDA. I time apportion accordingly. Other than that, the capital allowances computation is exactly the same. What we will do, we'll look at the period of trading. So let's have a look at what we've got here. We've got until 3rd of June 16, Wendy was employed as a management consultant at an annual salary of £40,000. She was an employee. But then, on the 1st of July 16, Wendy commenced in self-employment. She started to trade, there's that critically important date, the 1st of July 16. As soon as you read that in the question, started to trade 1st of July 16, what you can then do is to write next to that, so what tax year does that fall in? That would be 16/17. You now know what is your first tax year. The following information relates to the period of self-employment from 1st of July 16 to the 5th of April 17. So in this particular example, would be nice to you, the taxpayer has decided to choose the 5th of April as the accounting date. this could have been the 31st of March and the same basis of assessment and the same rules would apply. But to the 5th of April. The adjusted profit for that trading period, 1st of July 16 to April 17, is 89,000, and that's before deducting the capital allowances, which of course is the bit that you are going to have to compute. Wendy purchased here the following assets. Okay, what have we got? And what do we write on the question page? Whenever you get your list of expenditure, we'll make sure that the dates that expenditure has been incurred or assets have been sold fall within your basis period. We started 1st of July 16, there's your first one, 1st of July 16. Remember, if you had, as you may have done, pre-trading capital expenditure, you'd bought something before you started to trade. In practice, you probably would have to. Then again, that's fine. Pre-trading capital expenditure, you treat it as if it was bought on the first day of trading. It goes into your capital allowances computation as normal. What is it? It's recording equipment there. That means that the £30,000 normal plant and machinery will be eligible for AIA. What level of AIA? Well, it won't be a problem as the expenditure is only 30. But that opening period, 1st of July 16 to 5th of April 17, how many months is that to the nearest month? Hope we'll agree that that is 9 months. So here we'd know that the maximum AIA for that opening period would be 9/12 of the £200,000, which, as we mentioned a moment ago, would be 150. At the moment, I've only spent 30,000, so all of it will be eligible for AIA. Now, what do I buy next? Motor car, CO2 emissions, 170 grams per kilometre, used by Wendy. 60% business use, 40% private use by Wendy. Remember, Wendy is the proprietor. She is the unincorporated trader. Therefore, this is an issue. If you have an asset with private use by the proprietor, then you must restrict the capital allowances claim to the business use proportion. Here, 60%. But what allowances do we get on cars? Now, you should know that with a car with emissions above 75 grams per kilometre, below that would be first year allowance. But above it, no AIA, and it's only writing down allowance. The then question is, what level of AIA? Based on CO2 emissions, is it going to be main pool, or the main pool figure of 18%, or would it be the special rate pool figure of allowance, 8%? Which would it be? Now, of course, given that this car has got private use by the proprietor, it doesn't go to either pool, it's in its own separate column, and whatever capital allowance, whatever writing down allowance we compute, we will restrict to be able to claim only 60% of that. But at 170 grams per kilometre, you should know that we'll be talking about a writing down allowance being available, and it will be available at only 8%, there, the lower level. Another motor car here with emissions of 125 grams per kilometre, used privately by employee, then that private use is irrelevant. Private use by an employee, we don't care. Full capital allowances will be available. With CO2 emissions of 125, again it's WDA, and this time it will be 18% writing down allowance that will be available to her. Computer, again, when you see computer equipment, you might think about short life assets, but here, given that you've got £150,000 worth of AIA available, and you've only used 30,000, or would be using so far 30, then on the 2,600, you will make your full 100% claim for AIA. When you've done that work, you should now, following what you've done in Chapter 5, be able to put together the capital allowances computation. Remember the structure of that? listing firstly the additions eligible for AIA, claiming the AIA, then listing the additions that are eligible for WDA and only WDA, that is basically cars other than low emission cars, and they would go to main pool or special rate pool or an asset with private use by proprietor, separated out in its own column where you've got private stroke business use by proprietor. Having got your figures then, calculate your WDA, and when you do your writing down allowance, what have you got to remember? What is the length of the period? It's 9 months. So again, the WDA will be 9/12 of the available 8% or 18%. We time a portion there, the allowances accordingly. 9 months. Work out the WDAs only after working out what is 9/12 of 8%, 9/12 of 18%. Working out those WDAs on those two cars, only after you've done that would you then restrict the allowance, in the case of Wendy's car, to the business use proportion. What I want you to do, therefore, is have a go at that, work through that example, work through the answer, make sure that you're happy with it before we see you next time for, again, what will then be, I'm happy for you to say, what will be the final session in this particular chapter.